Dear students, welcome to our channel. In this video, let us continue to discuss few more problems in Goodwill, Nature and its Valuation. This is for Chapter 2, CBSE Class 12 Accountancy Part 7 video. In the previous, I have already posted 6 videos for Chapter 1 and 2 explaining the theoretical concepts and discussing few practical problems, and I have given the link in the description. Please make use of it. And we all know that there are 20 multiple choice questions in the board exam for accountancy paper. Keeping this in view, I have prepared chapter wise MCQ test and chapter wise revision test based on the previous year board exam questions. The link for this test is given in the description. Make use of it. Now, Goodwill valuation under super profits method. We are given with the question details about two partners, Alok and Akash, and they are going to admit a new partner, Ashish, and it was also decided to value the goodwill on 3 years purchase by super profit method. For this, we are given with the details of 5-year profit. To start working on this, let us break down the question into small details. Alok and Akash are partners and the new partner is Ashish. From 1st April 2023, they decided to admit him. The goodwill is decided to valued on based on 3 years purchase under super profit method. And we are given with the details about the last 5 years profit. The question is given with the details about the last 5-year profit. And we are also given with some other details as capital employed and the normal rate of return as 10%. With this, we are asked to value the goodwill. To start working on the question, firstly, we will estimate the actual average profit. Estimation of actual average profit. We are given with the profit details for 5 years, 31st March 2019, 31st March 2020, March 2021, 31st March 2021 and 2022, and for 31st March 2023. We are given with the profit details for 5 years. It is given as 2 lakhs, 1 lakh 70,000, 2 lakh 10,000, 2 lakh 30,000 and 2 lakh 50,000. In the question, we are also given with certain other details as for the year ending 31st March 2018, the profit was included with the gain of rupees 25,000 from the sale of a fixed assets. Any gain from the sale of fixed assets is an abnormal gain and it should not be considered for the normal business transaction profit. So the abnormal gain is to be deducted from the normal business profit so that the actual business profit will be arrived. Adjusting this abnormal gain, we will be arriving the adjusted profit as 1,75,000 for the year. For the next year, for the year ending 31st March 2020, we are given with that there was an abnormal loss. This abnormal loss would have brought down the actual profit of the business, which should not be considered. So we will add back the abnormal loss. Abnormal gain would have increased the actual business profit, so it is to be deducted. Abnormal loss would have reduced the actual business profit, so it is to be added back. So when we add this, it is 50,000 adding, we will get the adjusted profit as 2,20,000. Abnormal gain deducted, abnormal loss to be added back. For the rest of the years, there is no such detail, so we are considering the same profits 2,10,000, 2,30,000 and 2,50,000. Adding all these profits, we arrive at 10,85,000. From these details, we will be calculating the actual average profit. Estimation of average profit. The average profit is the total profits earned divided by the number of years. The total profit we have arrived it as 10 lakh 85,000 and number of years is given as 5 years. So it is 2 lakh 17,000. This is the actual average profit earned, and we will be calculating the normal profit. The normal profit. For this we will be considering the capital employed, which is given in the question as 15 lakhs, and the normal rate of return, it is given in the question as 10%. The normal profit, this is the expectation of the firm that they will earn from the business. It is calculated as a percentage on the capital employed. So normal profit is capital employed into normal rate of return. That is, normal profit is rupees 15 lakhs into 10%, which is equal to rupees 1,50,000. The normal profit. Now we have to calculate the super profit, because here we are going to value the goodwill based on the year's purchase on super profit. For that we need super profit. Calculation of super profit. Super profit. In a business, the firm expects to earn certain amount of profit, that is normal profit, but the actual profit is more than what is the profit that is expected to earn. Such a profit is said to be the super profit. So super profit is actual average profit. From this we have to deduct the normal profit. The actual average profit in this question, super profit, the actual average profit we have estimated as 2,17,000. This is the actual profit that the firm has earned, 2,17,000. From this, the normal profit of 1,50,000. This is the expected returns from the business operations. It is 1,50,000. So the difference amount is rupees 67,000. So this is the super profit. And finally, we will be estimating the goodwill value of goodwill. Value of goodwill. We are given in the question that goodwill is to be valued on super profit method for the 3 years purchase. So goodwill is super profit into years of purchase. Number of years of purchase. So the goodwill. So goodwill. Super profit we arrived it as rupees 67,000 with the years of purchase 3 years, which is equal to rupees 2,01,000. This is how we calculate the goodwill under super profits method. Next question in goodwill valuation under super profits method. We are given with a question details about the average profit earned by the firm is 2,50,000, and in this question a new component is given, that is overvaluation of the stock. The stock has been overvalued, and we are asked to find out the goodwill based on the super profits method. The goodwill we have to work it out on the super profit method. To start working on the question, firstly we divide the question details. Average profit earned is 2,50,000, and there is a situation of overvaluation of the stock to the extent of 10,000. The money invested in the business is 14 lakhs, and the expected normal rate of return is 15%. We are asked to calculate the goodwill on the super profit method considering 4 times of the super profit. Now to start working on this, firstly we will adjust the overvaluation of stock. The average profit given in this question is rupees 2,50,000, and we are given with a situation that the stock has been overvalued. So the actual average profit becomes rupees 2,50,000. We deduct the overvaluation of the stock for the reason that this overvaluation of stock might have increased the real profit earned. When we deduct, we get the actual average profit. It is 2,40,000, the actual average profit. Then we will estimate the normal profit. We discussed earlier that normal profit is the profit expected on the capital employed in the business. So capital employed multiplied with the normal rate of return. Normal rate of return. This normal profit is calculated as a percentage on the capital employed. In this question, we are given with a situation that the capital employed, it is given in the question as rupees 14 lakhs, and the expected normal rate of return is 15%. So it is 2,10,000 is the normal profit. Then super profit, we discussed earlier. Super profit is the excess profit beyond the actual expected profit. We expect the business to earn a certain amount of profit, but the actual profit is more than the expected profit. So the extent, the difference between the actual average profit and the normal profit is the super profit. So super profit is actual average profit. From this we deduct the actual average profit is more than the normal profit, that is the expected profit. The difference amount is the super profit. So therefore super profit in this question, super profit is the actual average profit. We have estimated it as 2,40,000. From this we deduct the normal profit. Normal profit we estimated as 2,10,000. So the super profit is rupees 30,000. Now we are asked to estimate the goodwill. The goodwill in this question we are asked to estimate as an 4 times the value of super profit. 4 times of super profit. So we estimate we multiply the super profit. We estimate the super profit with 4. So goodwill is 4 multiplied with the super profit of rupees 30,000, which is equal to rupees 1,20,000. So we have calculated the goodwill. So next question in goodwill valuation through super profits method. We are given with the question details about the assets and liabilities. In this question, we are readily given with the goodwill value. The question gives us the details about the goodwill value, and we are asked to estimate the average profit of the firm. The goodwill value is given, but we are asked to estimate the average profit of the firm. That is, we have to reverse work the question details. Now as usual, let us break down the question details. Here in this question we are given with assets 5 lakhs, partners capitals are 3,50,000, general reserves is given, sundry creditors are given, the normal rate of return, the expected business returns is given as 10%. We are given with the readily given with the goodwill of the firm, and this goodwill is valued based on this goodwill is being estimated based on the super profits method. We are given with the goodwill, and that has been estimated through super profit method, and we are asked to estimate the average profit of the firm. What is the average profit of the firm? Now let us start work on the firstly we are given with goodwill. Goodwill is given in the question as rupees 90,000, and this goodwill is estimated based on super profit method. It is given in the question itself. Super profits method. Now we know that goodwill through super profit method is super profit multiplied with years of purchase. Goodwill, we know that it is given as rupees 90,000, and super profit, we are to calculate this super profit, and it is given in this question that the goodwill is based on 2 years purchase of super profit. So 2 years purchase. That means when we bring down this 2 years, the number 2 to right hand side, that is rupees 90,000 divided by 2, which becomes the super profit. That is, therefore the super profit is equal to rupees 45,000. We already discussed that super profit is the excess profit beyond the normal profit. We actually expect to earn a certain amount of profit in the business. That is said to be the normal profit. And the actual average profit is over and above the normal profit. That excess of actual average profit over the normal profit is said to be the super profit. So super profit is equal to average profit less, we have to deduct the average profit, normal profit. The normal profit is to be deducted from the average profit to arrive the super profit. We have estimated the super profit as 45,000. The super profit is being estimated as 45,000. Now the thing is, one component, that is super profit, is being estimated. Now we have asked to calculate the average profit. For that, firstly we need to estimate the normal profit. We have already discussed that normal profit is to be calculated as a percentage on the capital employed. So normal profit is capital employed into normal rate of return. Now what is the capital employed? In this question we are not given with the capital employed details directly. So we have to firstly arrive the capital employed. The capital employed, we are given with certain details like assets and liabilities. When asset details are known, we will deduct the liabilities from the assets. We will deduct the liabilities from the assets. Now the assets, in this question the asset details are given. So we will firstly arrive the capital employed. The assets details are given. It is given as 5 lakhs in the question. From this we will deduct the liabilities. The company's creditors are the liabilities. In this question it is given as company creditors as rupees 90,000. So we get capital employed as 4,10,000. So capital employed is known. To get the normal profit, normal profit is calculated as a percentage on the capital employed. So normal profit is capital employed, we arrived it as 4,10,000. In this normal rate of return, it is given in the question as 10%. So the normal profit is 41,000. So the normal profit is being arrived, and we have also estimated the super profit. That is, super profit we have estimated as rupees 45,000, and the normal profit we arrived it as rupees 41,000. So taking this 41,000 to the left hand side, what will happen is rupees 45,000. With this, on the right hand side it is negative deduction, so it will become an addition of 41,000. So average profit is, when we add 45,000 with 41,000, it is 86,000. So therefore average profit is rupees 86,000. This is what we are asked to estimate. Giving the goodwill based on the super profit method, we were asked to estimate the average profit, and we have estimated the average profit as 86,000. Next question on goodwill valuation. Goodwill valuation. In this question, we are asked to estimate the goodwill based on the capitalization of average profits method. Average profits method. We are given with the certain details. A firm earned some profit, normal rate of return is given, and the assets and liabilities details are given. And the goodwill should be evaluated based on the capitalization of average profits method. To start working on the question, we will break down the question details into hints. The firm earned a profit of 60,000. The normal rate of return is 10%. Assets are 7,20,000. Liabilities are 2,40,000. And the goodwill is to be valued based on the capitalization of average profit. First, let us understand what is this capitalization of average profit method. In the question, we are given with a normal rate of return for the business. This means the business is expected to earn profits at the rate of 10% on the capital that they have invested. The firm has actually earned 60,000 rupees. We are expecting 10% returns. The firm has earned 60,000. Based on this normal rate of return, what should have been the capital? This is to be calculated first. So, the total capital value of firm based on the normal rate of return, it is to be estimated. So, actual profits earned divided by the normal rate of return. Normal rate of return into 100. This will give us the capital value of the firm based on the normal rate of return. So it is the actual profit earned is rupees 60,000. It is given in the question itself, and this firm is expecting to earn a normal rate of return at the rate of 10%. So based on the normal rate of return, the company's capital should be 6 lakhs. The company's capital should be. The company has earned 60,000 and the expected rate of return is 10%. For this, the capital should be 6 lakhs. But the actual capital of the firm, this we can arrive by deducting the total assets. That is, the assets, from this we have to deduct the liabilities. This will give us the actual capital. We are given with the details about the total assets and the liabilities. So the actual capital is the total assets rupees 7,20,000. From this we deduct the liability of rupees 2,40,000. All the details are given in the question. So the actual capital is rupees 4,80,000. The actual capital. The company's capital based on the normal profit should be 6 lakhs. But the actual capital is 4,80,000. That means this firm has earned more than the capacity of the actual capital invested. So that means the company's goodwill is the amount exceeding. That is the total capital exceeding the actual capital. So goodwill is total capitalized value of firm, total capitalized value of the firm. From this we have to deduct the actual capital. That means the goodwill is, we have arrived the capitalized value of the firm as 6 lakhs. From this we will deduct the actual capital of 4 lakh to get the goodwill, that is 1,20,000. This is how the goodwill is to be estimated based on the capitalization of average profit method. Next question. This is goodwill valuation by capitalization of of super profits. Here we are going to evaluate the goodwill by capitalizing the super profit. We are given with the question details. The average profit of the firm is given, assets and liability details are given, and the normal rate of return is given. Our question is to calculate the goodwill based on the capitalization of super profits. To start working on the question, first let us divide the question details into hints. Average profit of the firm is 1,50,000. The firm's assets are 14 lakhs and the company's liabilities are 4 lakhs. And the normal rate of return, that is, this is the expectation of the firm to earn profit on the capital employed is 10%. And our question is to estimate the goodwill based on the by capitalizing the super profits. So we are asked to calculate the goodwill by capitalization of super profit method. Now we will start working on this. Firstly, we will estimate the capital employed. The capital employed is total assets. From this we have to deduct the liabilities of the business. So in this question we are given with the assets and liability details. The company's assets are rupees 14 lakhs and from this we will deduct the liabilities as 4 lakhs. So we will end up with an capital employed of rupees 10 lakhs. So capital employed is 10 lakhs. Now to know the normal profit, that is normal profit, this is the profit expected to be earned. It is capital employed. The normal profit will be calculated as a percentage in the capital employed. It is normal profit equal to capital employed into normal rate of return divided by 100. And this value is normal rate of return by 100. Now the normal profit, it is the capital employed, we have arrived it as 10 lakhs. The capital employed, we have arrived it as 10 lakhs. And normal rate of return is, we are given in the question as a 10%. So the normal profit is 1 lakh. The normal profit is 1 lakh rupees. 1 lakh is the normal profit. The normal profit is the expected profit to be earned on the capital employed. Now we have to calculate the super profit. As we discussed earlier, super profit is the excess profit over the normal profit. Actually, the average profit is to be the average profit that exceeds the normal profit, that is the super profit. Average profit, from this we will deduct the normal profit, we will get the super profit. So the super profit is to be calculated from the by deducting the normal profit from the average profit. In this question we are given with the details of the, so the super profit is average profit. We are given the average profit in the question. The average profit is 1,50,000. It is given as 1,50,000. And the normal profit is given as, the average profit, it is given in the question as rupees 1,50,000. And the normal profit, it is given in the question as, we have estimated the normal profit as rupees 1 lakh. 1 lakh. So the super profit works out to rupees 50,000. In this question, we are going to value the goodwill based on the capitalization of the super profit. That is, goodwill will be calculated by capitalizing the super profit. That is, goodwill, we will capitalize this. For this, we will be applying a formula, that is super profit divided by normal rate of return into 100. Normal rate of return into 100. So goodwill super profit, we have estimated it as rupees 50,000, and super profit we have estimated as 50,000, and the normal rate of return we know that it is a 10 percentage. So it is divided by 10, the normal rate of return. So the value of goodwill is rupees 5 lakhs. Is rupees 5 lakhs. This is the value of goodwill by capitalization of super profit. Next question on goodwill valuation. In this question, we will be working out the goodwill valuation on all four methods that we have already discussed in the previous questions. So we are given with the question details about the company's capital employed, profit details, expected rate of return, that is normal rate of return, partners remuneration, everything. And we are asked to estimate the goodwill under four methods. To start working on this, we will first break down the question. The question details itself is given as a hint. So directly we can start working on that. So we are going to work out the goodwill valuation, make out the goodwill valuation. The first method is at 3 years purchase of average profit. The first method we are going to work out with the goodwill on 3 years valuation. Goodwill at 3 years purchases of average profits. We are given with the goodwill details for 3 years, that is for the year 2021, 2022, 2023, and the profits are given as 1,60,000, 1,40,000 and 2,70,000. Totaling all these things, we will get a total profit of 5,70,000. From this, we will be working out the average profit. The average profit, as we learnt already, the total of profits for all these years divided by the number of years. It is that average profit is, therefore the total of profits is, we have estimated as 5,70,000, and the number of years, it is for 3 years, and so the average profit works out to rupees 1,90,000. Here in this question, we are given with a manager's remuneration. So the actual average profit is to be estimated. It is estimated by deducting the average profits. By deducting from this average profit, we have to deduct the partner's remuneration. The partner's remuneration is given. Whenever you find a partner's remuneration, that is to be deducted. So the actual average profit is average profit, which we have estimated as 1,90,000. From this, the partner's remuneration is given as rupees 2,500. Rupees 2,500 for each partner. So for two partners, and this is monthly, 2,500 is for per month. So for 12 months, we have to estimate. So the actual average profit is rupees 1,90,000. From this, we are going to deduct the partner's remuneration, which works out to 60,000. So actual average profits is equal to rupees 1,30,000. After estimating the actual average profit, goodwill, we have to find out the goodwill. The goodwill in this question, we are asked to estimate through average profits on 3 years purchase. So actual average profit, we are asked to estimate the goodwill on 4 methods. The first is based on the actual average profit into years purchase. The number of years of purchase. It is based on the years purchase. The goodwill is the actual average profit we are estimated as 1,30,000, and we are asked to evaluate the goodwill based on 3 years purchase. So goodwill purchase is 3,90,000 on the based on the years purchase of the actual average profit. This is the first method of evaluating the goodwill. Then next method of goodwill valuation, we are asked to estimate the goodwill. The second method we are asked to work out is the goodwill at 3 years of purchase of super profits. This is the second method we are asked to estimate 3 years of super profit. We have many a times discussed that super profit is the excess of actual average profit over the normal expected profit. So for this, we have to first get the normal profit. Normal profit, we know that it is to be calculated as it will be calculated as an percentage on the capital employed. So normal profit is capital employed into normal rate of return divided by 100. So firstly we have to estimate the normal profit. So the normal profit, to calculate the normal profit, we have to consider the capital employed, which is given in this question as 10 lakhs as the normal capital employed, and the normal expected rate of return is given as 11%. So the 11% is the normal expected profit. So the normal profit, we are given with the capital employed, it is given in this question as 10 lakhs, and the normal rate of return is given in the question as 11%. So it works out to rupees 1,10,000 is the normal profit. And super profit, it is the actual average profit. From this we have to deduct the normal profit. From this we will be deducting the normal profit. So super profit equal to the actual profit we have already estimated in the previous division. It is 1,30,000, and normal profit we have estimated as 1,10,000. So the super profit is 20,000. Super profit is 20,000. Now we are asked to estimate the goodwill based on the 3 years purchase of super profit. So goodwill equal to super profits into 3 years purchases. That is goodwill equal to super profit is 20,000 into 3 years purchase. 3 years, which is rupees 60,000. Next method is the estimation of goodwill under capitalization of super profits. We have already estimated the super profit and we have calculated the goodwill based on the year's purchase of super profit. Now we are asked to estimate the goodwill based on the capitalization of the super profit. That is, for this super profit, what would be the capitalization value of the goodwill. So for this we have already discussed these formulas. Goodwill valuation is super profit multiplied by 100 into normal rate of return. This will give us the capitalization, goodwill under capitalization of super profits. So goodwill under this method is super profit we have already estimated in the previous subdivision. It is 20,000 into the normal rate of return. It is given as 11. I have already pre-estimated the value for time saving purpose. So the goodwill is 1,81,818. It runs in fractions. I have rounded off the value. Then we are asked to estimate the goodwill, estimation of goodwill. Here it is based on capitalization of average profit. Goodwill, estimation of goodwill under capitalization of average profits. The previous method is capitalization of goodwill under super profit. Here we are capitalizing the average profit for getting the goodwill. That is, goodwill, the total capitalized value of the firm. The goodwill is total capitalized value of firm. From this we have to deduct the actual capital. This method is, we are given with a certain percentage of normal rate of return, and we have also evaluated the actual average profit. The actual average profit we have evaluated. For earning this actual average profit, what should be the capital? That is the total capital value of the firm. the total capitalized value of firm is, we have estimated the actual average profit and based on the normal rate of return, what should be the total capital value of the firm? It is 100 divided by normal rate of return. Now we will first calculate the total capitalized value of the firm. The actual average profit we have estimated as rupees 1,30,000. Normal rate, it is given in this question as 11. So for this normal rate, our capital value should be rupees 11,81,818. I have pre-estimated the value and rounded off for the fractions. So the total capital value of the firm based on the normal rate of return should be 11,81,000. But the actual capital, we have to find out what is the actual capital. The actual capital is nothing but the total assets. From this we have to deduct the liabilities, and actual capital in this question we are given with the total assets value as rupees 11 lakhs. It is given in the question itself, the details. From this we have to deduct the liabilities. The liabilities are given as rupees 1 lakh. So the actual capital is 10 lakhs. Based on the normal rate of return, the total capital value is 11,81,818. The actual capital is 10 lakhs. So the capitalized value of the firm is more than the actual profit. That difference is the goodwill. Therefore, goodwill of the firm is total capitalized value of firm. From this, when we deduct the actual capital, we get the goodwill. So we have estimated both these values. So the goodwill is rupees, difference between the 11,81,818 deducting the actual capital of 10 lakhs. We get a goodwill of 1,81,818. So we have estimated the goodwill on all the 4 methods. Okay students, as we discussed in the beginning of the video, I have prepared the chapter wise MCQ test and revision test based on the previous year board exam questions, and the link is given in the description. Make use of it. And our next series of video starts for chapter 3, change in profit sharing ratio for class 12 CBSE accountancy. Your like, share, comment and subscription to the channel may encourage me to post more such videos. Thanks for watching.